Welcome to Energy Talks, the podcast for energy nerds and those who like interesting conversation. My guest today is Kevin Birn, energy economist at S&P Global, and we're going to be talking about the oil sands. So welcome to the interview, Kevin.
No, it's a pleasure to be here, and I like to call myself an energy nerd too.
I when I talk about energy nerd, the image that pops into my head is you.
Oh, well, I got to get a pocket protector then just to really seal the deal.
I believe you had one in the past.
My old man had them. I don't know if I still have any kicking around. So,
Well, look, you guys have just released the 10th report, I think. Canadian oil sands production expected to reach all-time highs this year despite lower oil prices. I've been interviewing you for 10 years about the oil sands, and we've talked about these kinds of reports many times. So why don't you just give us the high-level overview, please?
sure. Our expectation is the oil sands will continue to grow. That's not different from last year. But what we've done here is we've revised up our expectation of that growth by almost, I'd say, 100,000 barrels. Just call it even, Stephen. And that's 100,000 barrels more by 2030, right? Because it's a time series through time. And the principal drivers behind this is the same thing we've seen last year and the year before, is we've seen the industry really focus on optimization of existing facilities. So what does that mean? They're really focusing on how to keep that facility running harder and faster and producing more units and how to reduce downtime, and then taking the infrastructure and the energy consumption they have, how do you get more things out the door from that? So make more money off of what you've already invested in effectively. And that's a little bit harder to forecast because it often comes from learning by doing. So those investments and those decisions are made in a more near time environment, and our outlook goes out 10 years. And so what happens is we continually see a little bit of upside at the end of the year because we get more expectations. We also have the assumption that that can't go on indefinitely either. And that's why we've been revising up.
See, now this is a good conversation to have because the Premier of Alberta, Danielle Smith, has called for the doubling of Alberta oil production. And so, in a hypothetical world, the only source of oil that could be doubled is the oil sands. And if there's a pipeline built to the West Coast and the new supply is needed, really the only place it's going to come is from the oil sands. So, realistically speaking, how much could the oil sands expand and do it so that their costs are low enough to be competitive in international markets?
There's a few things in there. Let me just unpack one of them. So the oil sands production, we expect to hit a record high again this year because it's continuing to grow. So this story of making records, expect it for a couple more years. The oil sands is about, we expect to hit about 3.5 million barrels per day on an annual average basis. There's about a million barrels, give or take, of conventional oil production in Western Canada as a whole, and another 600,000 more or less that comes from condensates. So there is the system in total would be, over 5 million barrels a day when you take the East Coast into it, most of that coming out of the Western Canadian. So it's not just an oil sands story. There is some significant resource potential. And one of those big resources, of course, is the Montney and the Duvernay, the Montney being the big beast in British Columbia. So to your question though, oil sands to continue to grow, we expect ongoing optimizations, but it would take new pots and pans to really accelerate that growth curve. What do I mean by new pots and pans? I mean new facilities, new central processing units being built out there, or large scale expansions of existings, which is something we don't see right now. On the unconventional side, the unlocking of LNG Canada will throw some liquids back in Alberta. There is a huge amount of potential in that play as a whole to throw a lot of liquids into the basin. But again, you'd need to see an incremental acceleration about the amount of capital that they're dedicating to that, and we still don't see that.
So, what we should talk about Greenfield versus Brownfield because Greenfield is starting something new. The capital costs have to be paid upfront, and Brownfield is optimization of your existing facilities, which you've already just talked about. So all of the incremental production over I don't know how the last 5, 6, 7 years has been Brownfield and incremental. So going forward, how much more? Well, I guess in your forecast, that's all brownfield, right? That's all optimization.
Yeah, these words are really tricky because they mean things to different people. When I think greenfield, I think of you know, I have to build a new road to an entirely new area. And if it's forested, I probably have to create a pad and take some trees down. If it's not, I still have to create infrastructure. Brownfield for me is you have a facility, you have a road, you have a CPU, and you physically expand that. So I put another, and when I say CPU, center processing unit, in the oil sands, they have to take oil and water and separate it. You need a unit to do that. Building another one of those beside what you already have, that for me is a brownfield expansion. What we're talking about when we say optimization is no new pots and pans.
Oh,
What you
okay.
got, you run. You might be drilling new wells because you're having efficiency in how you're separating your water, or you're using something other than water, so you have more ability to do produce more oil with the same amount of water handling. That is really holding what you got in optimization in my mind. So they're a little bit different, and there is a dramatic difference in cost structure. Brownfield, SAGD, I think we'd probably put, I'd have to ballpark it, $45, $50 kind of WTI break even, but your existing to exist to hold what you got in place, you're probably looking somewhere from 20 to 40 across almost all the oil sands. So 20 to $40 on a WTI basis. So for the oil sands, there's been a lot of things said about the resilience of oil sands. For the oil sands to really pull back, you need to see WTI hit prices that most world supply can't hold on to, and stay there for a protracted period of time.
Let's talk about the difference between half cycle costs and full cycle costs. Because, and I'll be honest with you, and all the times that we've talked about it, I'm still not sure that I've got a firm grasp on that.
Yeah,
So maybe why don't you explain it?
that's because it's confusing. So I'm going to completely validate your confusion over it. It's completely justified.
I sound a little confused.
Yeah,
Why?
all it really, the biggest difference is, and this is our language we use. I don't know if everybody uses half cycle, full cycle. A half cycle is the upfront capital, right? And so if you're going to build an oil sands plant, it takes a little bit of money. We're talking typically $1 billion for a smaller scale facility. It may be less now because of, redesigns and whatnot, but no one's pulled the trigger, so we don't have a great degree of data points. But that's money that you have to take out of the bank, get from a bank, you know, they loan you the money and put it out into pouring concrete and building steel and ordering turbines up from some of the industrial manufacturers out there. And that takes time. And so it's upfront, out of pocket expenditure that you put out there before you generate revenue from producing oil. Half cycle, you take that out. And that means I assume that that's sunk. You made the investment. I'm not going to include that in my break even cost anymore. And so that's the biggest difference in oil sands. That upfront out of pocket expenditure over multiple years puts a hurdle rate in bringing new projects online that, say, shale does not face because it doesn't have the same upfront out of pocket expenditure. It has quicker to oil. And so it's a smaller incremental, get the well online, and it's quicker to give the money back to you. So it's seen as lower risk as a result. However, for those we remember, there was that oil sands boom from 2000, say two, three to 2015, even 17 because it continued on to completion. A lot of stuff was built. And so there's a lot of that sunk capital. And so there's a lot of production capacity that exists in there. And that's the half cycle cost that we're talking about. Those are the numbers I was quoting you, somewhere between 20 to $40 to continue to produce that amount of oil that they're doing today, tomorrow.
And I'm leading up to something here because there's a really interesting chart in your report that reports half cycle costs. And as you say, some of the different types of production are at $20 West Texas Intermediate break even. Some are at 40 or even higher than 40. How much of the production breaks down by cost, the unit cost or the break-even cost, and what kind of production is it?
Sure. There's a lot there. I didn't really fully answer your last question though, too, and I'll go back and say that. Half cycle for us is not operating cost. So it includes operating costs, which would be lower than the numbers I just quoted you. So instead of $20, SAGD facilities, some of them are down into $8 for operating cost. So it is the operating cost plus the cost of diluent if they need to buy diluent, so they need to buy to blend to ship, plus the cost of transporting that diluent to market, as well as the oil to market, because we're talking. I'm giving you these numbers in a WTI basis, and that's traded down in Cushing, Oklahoma. So I have to move it. So it's the transportation cost, the diluent cost, the operating cost. That's why that value is higher than just operating costs we'll talk about, right? And so that's the amount of money that they need to get back at the price of sale. So this whole thing breaks even and they're kept whole. Everything above that would be return. right? And so that's the best way to think about it. Yeah, and those costs do vary. They vary dramatically across the oil sands. Like we talked about $20 on a WTI basis to $40. The weighted average of across all of those, the different forms of production, which is SAGD, which produces dilbit predominantly, mines that both produce synthetic crude oil, but actually is a premium crude oil, so it captures a higher price. So that transportation and quality differential actually works in their favor a little bit. And then mine dilbit, the average of all that when you do a weighted average is about $27 that we estimate in 2024.
So you've got what you're saying is that out of the 3.5 million barrels a day, there's actually a fair amount of production at the 20, $25 break even level in order to bring
Yeah, I
it
think
to
that's fair.
27.
Yeah.
Okay. That makes, and this is, I had been operating under the assumption, that there are other estimates of break evens out there. Rystad has got them and in a couple of other places. And these are the lowest that I've seen. And now, if you look at the amount of transportation costs they get this over to China or India, now I can see where some of these barrels would be a competitive barrel in those markets. Whereas if you look at the other numbers that I've been looking at, they were higher and they would suggest that those barrels would not be competitive because of high transportation costs. So I don't know if I have a question in there, maybe just an observation that you could comment on.
I think there's been a lot of confusion around oil sands cost and that half cycle versus full cycle bit we talked about. The bringing on a new mine, you're looking at easily north of 80, $85 WTI, and I'm being very optimistic. SAGD though, there's been a lot of descaling. It's now in a range where, even in the price we have, you could theoretically bring them on and have a return on investment that's justifiable to sanction that project. Um, those kinds of prices and the break-even costs are still higher than the cost it takes for all that capacity that exists. Like we're talking about over 3.5 million barrels per day of production we expect to average this year. The break even is even lower than that, right? So if you own one of these assets, you're going to continue to produce them, you're going to continue to run them, you're going to continue to sell that barrel. And with oil prices as they are now, which is less than last year, it's still in a place where these companies are loving those assets that they have.
Gotcha. Okay. I don't think you commented on my observation, so we'll let that stand. That
Well, I have to look at, me, I'm a nerd. I need to look at all the assumptions and the math. I don't think it's an issue in terms of making a return shipping through maritime to the Asia Pacific. I don't think it's a question of that.
right. Well, a question of not the maritime, but the TMX tolls, the Trans Mountain Expansion tolls, and whatever dockage and insurance and it comes out to about 17, $18, depending on how you do the math. So
Yeah,
anyway,
there's still room.
yes, there is. And that's what I was pointing out. I had been using some other numbers from other agencies that had different numbers than you did. So you've clarified something for me today. I appreciate that.
Okay. We've been talking a long
Um,
time, so that feels good.
okay, so we pretty much talked about everything that's in the report. What do you see? Because you do see production declining down into the mid by 2035. Yeah, I think it'd go down from 3.3 up to 3.9, then down to 3.7, 3.6, something like
Yeah,
that.
there's a lot of rounding in there, so these numbers are not perfect because we don't want to give away all the significant digits. But the other side of that comment is these are all forecasts. So the reality is ultimately going to be different. But what we see happening to the crux of your question is there is some of these facilities are going to get quite old around 2030. And so we do see the potential for some of these smaller, older facilities to start to wind down. We see the potential for some ore quality issues. We do see some potential for further upgrading of some bitumen coming from SAGD facilities. And for those people that don't follow this as well as much as you and I, when you upgrade bitumen, you have a volumetric loss. So you remove some of the asphaltenes from that process, and so you go from a barrel of oil to say 85, 90% of a barrel of synthetic oil, and so you have a volumetric outcome. Those things all kind of combine to result in that beginning of a decline in the oil sands, but it's relatively modest. And the other thing is we also do talk about the potential for upside here. Like There is potential for further optimizations that we don't anticipate. And that what that does is push that out further and higher out, that overall peak plateau and bend over of the production curve.
Gotcha. Kevin, thank you as always. My conversations with you are generally confusing, occasionally enlightening, but always entertaining. So thank you very much for this.
Well, I hope I didn't confuse your listeners. I'm happy if you're confused, but if they're good, we're good.